Alright guys, still on debit and credits. But right now what I want to quickly do is go over transactions. Alright, I spoke about the big five plus dividends. Alright, and now I want you to see why we've been speaking really, I guess, organically about what every single business terminology represents. And I'm going to try and go through a bunch of transactions. I'll pick up some of these index cards that I've been able to put together, and I'll talk about the sort of transactions you may see. And obviously, I want you to think debit, credit. We understand that debit's the left side and credit's the right side. And we know that if something is a credit account, then whenever it increases, we write the amount increased on the right side. We understand that if something's a debit account, we write the increase on the left side. All right, so keep that in mind. And we also went over dealer. So we understand that our dividends, expenses, and assets, when they increase, we debit. Our liabilities, equity, and revenue, when they increase, we credit. But I'm just going to go through some really quick examples. And do not worry, I'm not going to just leave you with the whole remember dealer thing. I actually want to boil everything down. Before we boil things down, before we get into the soup of things, wait a minute. I'm not even sure the soup of things is the thing anyone says. Well, before we get into the meat of things, I think I've heard people use that. So before we get into the meat of things, let's just quickly go through things just to see how things move. So think of the big five plus dividends, and we'll start with assets, right? So we understand that when assets increase, we're debiting. So let's see why. This is in no particular order. I actually did not organize this, and I probably should have gone through this before I made the video, but I'm going to take a chance here. Assets. So everything in this pile, all right, that I did arrange. So I separated everything that we would consider assets. Assets. If it increases, we're going to debit. We're going to write it on the debit side of things, the left side of things. Prepaid stuff. An example. So we have electricity bill. Well, actually, no. Let's say rent. Rent is something that would usually prepay to our landlord. What the transaction would look like? Gave $100 cash. Well, gave $1,000 cash for rent. Prepaid $1,000 cash for rent for upcoming month. What would it look like? We lost some cash. Okay, we gave cash away, so cash would go down. That stuff we have, it would go down. So we would credit that side, and our prepaid expense would go up. So we have to debit that side. It increased. Okay, so I always like to relate everything to cash, and we just saw an example of we paid stuff, so our cash was going down. So in my mind, I'm thinking assets. When it goes down, I'm going to the credit side of things, and I know I have to fill in the left side at this point, and that's the prepaid stuff. So let's go a little bit quicker. Other assets, we don't really have to bother too much, but if we purchase more stuff, we're usually going to spend cash. So if you're spending cash, you're losing cash, and that's your crediting cash. And then the other asset, whatever that other asset is going to increase. You're going to debit it. Current assets, just assets that you expect to liquidate within a year. It's similar to what I just said about the other assets and the prepaid stuff. Inventory. Okay, so things that we plan on selling. Obviously, how am I going to sell things if I have nothing to sell? So either our supplier is going to let us borrow the stuff, so we'll pay him back for it later, or we're going to just pay for it right out with cash. But let's say we borrowed, okay? Inventory, cash. Cash is an asset, right? Inventory is also an asset. It's stuff we have. We have cash. We have ready money. We have inventory. So let's say we borrowed this inventory and we plan on paying back later what it's worth. What we would do is we would credit our accounts payable, and we would debit inventory because we have more stuff. It's an asset. So when it increases, we're going to debit the account. Property, plant, and equipment, same deal. We have more stuff. It's increasing. Land, same thing. It's increasing. We have more stuff. Cash, the king of everything. When I do my T accounts, when I do trial balances, I always think, how has cash been affected? If I know that it's being debited, I know I'm looking for a credit somewhere. It's either going to be a credit for liabilities, a credit for equity, or credit for revenue, but it's going to come from somewhere. All right. Accounts receivable. People owe me money. Okay, so I have more promises that people are going to pay something. It's an asset. So if I keep selling things, but I'm not getting cash, but I'm getting people promising to pay me later, that's still increasing. I have more stuff. I have more claims. to stuff. Okay, so my inventory may be going down, but at least I'm getting more promises that I'll get money in the future. Okay, so that's how that works. Liabilities, this we know it's a credit account because if you do dealer, it falls on the right side. So what are our liabilities? Notes payable. Again, notes payable is just a promissory note that we're going to get, that we're going to pay back some money that we're borrowing right now. So a bank gives us $100,000. Now I have ready $100,000. That's money's increasing. So my cash is an asset, which we just went through. That's going to increase. We're going to debit it. And we owe more money now. So that's going to be a credit of our notes payable. See how it always balances out? Accounts payable, same thing. I went over an example with assets. But, again, if we owe more, it's a liability. It's increasing. We're going to be crediting. Current liabilities, same drill. Unearned revenue. Okay, so let's stick with the phone company. And we made phones, people love them, and they want them so bad that they're giving us their money ahead of time. We're going to consider a liability. They're giving us their money, or accounts, or they're promising that they'll pay us, so they swipe their card online or whatever. So we are getting stuff. We're either getting cash or we're getting promises. So we're going to debit on the left side the more stuff that we're having, our assets, and unearned revenue would be credited because it's increasing. We're still liable. We have to now at this point deliver those phones. See how it works? Accrued expenses, same thing. Our bills are starting to pile up. We're running the show, but we haven't been paying our bills. So what can you expect? Why do I always go back to cash? I expect to pay in cash, and my cash is going to go down. So this is a credit account. When this goes up, my cash is going to go down. All right. So if I'm paying off my accrued expenses, that means my accrued expenses are going down. So it's being debited. And my cash is being credited at this point because I'm paying them off. All right. And I'm not going to try and get caught up right now, but if you think really critically about the statement of cash flows and why we have to do some subtractions and some additions, whenever certain things are changing, the current assets and the current liabilities, I'm not going to walk you through this one, but if you can try and figure out the connections to how I'm debiting and crediting, then you know it. You understand completely. But for right now, you can just take it step by step. Try and think, how is cash being affected? How is the stuff I have being affected? Accrued expenses are liabilities. So I'm going to have to, if I pay them down, if I give up some cash, cash is credited. And this is going down. But if this goes up, what happens? We're going to credit accrued expenses. Okay? So liabilities, it's going to be a credit account. Equity, I want to say for last. Revenue, we just keep collecting more and more money. That's all it is. We're just collecting money for the services or goods we're providing. But we are delivering. It's unearned revenue if we don't deliver. But if we do deliver, it's revenue. So the more this increases, it's a credit account. That's all you have to really remember. Okay, it's a credit account. Expenses. This is a debit account. All right, so think about SGA, our selling general administrative. We have a bunch of bills to pay. All right, advertising, supplies, or whatever it is, our electric bill, internet, cable. We have TV in our office. So those things, if you think about it naturally, as they go up, what's going to be going down? We're going to be paying cash, right? Just paid our phone bill. We have less stuff now because we had to give it up to run the show. Okay? So this is a debit account. Expenses are debit account. Taxes. So think about what a transaction would look like. Just paid taxes. I don't think the government collects. I don't know if they collect IOUs. From my experience, they collect cash. So think, I just paid my taxes. The amount of taxes I've paid in my life just increased. It's a debit account. You know why? Because I think everything in relation to cash, what's happening to my cash as this is increasing, as in my lifetime I've paid more taxes, I must have given more money up. So my money must have been decreasing. So my cash has been credited because assets, when they decrease, we credit them. So this is going up because there used to be a balance. So when taxes go up, when we're paying taxes, we are debiting. This is really the same thing for any expense. What I just said for taxes, hopefully, and rephrase. I think I did a better job explaining why taxes, tax expense, I should say specifically, or as a debited account. So if you could follow that thought process, what I said about taxes, use it for interest expense. Okay, we borrowed a bunch of money, and as time goes on, we have to keep paying interest on it. Think of how it's affecting our cash. Okay. Same thing with our selling, general, administrative expenses, any expense period. Okay, I saved equity for last because equity is one of those weird ones. It's one of those weird ones that you're not going to see the transactions listed specifically as equity. So assets, you'll see cash, and you just understand naturally that that cash is you'll see cash, and you'll understand that, okay, cash is something we have. It's ready money that it's at my disposal. Accounts receivable, it's promises to pay. I have that. I have those promises, and they always act in the same way. But with equity, you're not going to see things that seem as directly related to equity. You'll see common stock, and you have to remember that common stock and preferred stock relate to equity. Okay, so if we increase common stock, if we increase the amount of money that we have as a result of issuing shares, so that's a transaction. You'll see issued 100 shares, received $1,000 for shares. Our cash went up, right? Again, I'm relating to cash because we just got a bunch of money for issuing the shares. So if we're debiting cash, because it's an asset, that's easy for us to visualize. We must be crediting equity. You see? This is one of the easier ones to remember when you think of equity. Equity is very easy for people to relate to stock. All right, but I still think equity is a strange one because then you have to think of your war chest, your dividends, all right, your withdrawals. If you take money out of your war chest, you're rewarding. So we're just talking about dividends right now. You're rewarding your stockholders, and that's a transaction you see. Paid out, let's say it's a sole proprietor. The owner of company took out $50,000 from company. Okay, try to work that out in your mind. What's going on right now? Paid out. So anytime you see dividends being issued, forget about all the millions of people that are affected. It's going to confuse you. Just consolidate all of them into one person. Dividend paid out $1 million. Fine. We gave $1 million to one owner. What's going on? Our company just lost some cash. Cash went down as a result of dividends. So cash going down is a credit to cash. So that means dividend has to be a debit account because we need that balance, remember? So retained earnings, again, this is still under equity, but I like to separate them and just understand that there's supposed to be a link. So if I look at a balance sheet, I know that. So you have to just remember this. I'm giving you examples of transactions you'll see, but always try and relate them to the stuff they're going to affect. Relate them to assets, because assets for me is very intuitive. It's easy to see how assets are being affected. So retained earnings, our war chest. If we take out of it dividend withdrawals, we're debiting. I mean, we're debiting. I spoke correctly. We're debiting. What if we are putting money into it? See how weird it is? We're putting money back into the company. So let's say the sole proprietor of the company decides that he's a person. He doesn't just have this business. He has a second job or whatever, second company, and that company's made a lot of money, and we need the money in this company. So in our war chest, he could just add in capital. So when he's adding in capital to our retained earnings, it's going to be a credit. All right, our retained earnings is going to be a credit account because it's increasing as credit. Equity is increasing. Hopefully, if you just kind of just sat back and went, oh, okay, I get that. That makes sense. Then you're fine. But for me, it took me a while to just realize that. But that's really all it is. I always try to use assets as my starting point, and I just think, okay, I have this stuff. How am I paying for this stuff? What's being affected? What is it? If my cash is going down or the things I have are going down, then that means something else must be debited. And that's how I start. Okay. So again, I'm going to actually draw everything out, but these are the kind of transactions you're going to see, and you need to realize that every transaction is going to have a double entry. Double entry accounting. It's a term that we use. This is why everything I basically just talked about